Hi, I'm Dominic Picardo here for the March edition of Spreadbet magazine. Today, to take a look at the forlorn looking chart of the British pound against the US dollar. And just lately, the bottom has been falling out of the world for the British pound. Sterling has been sliding aggressively against a whole range of currencies since the start of the year, including notably the US dollar. At the start of the year, the pound was up around, the pound made this intraday high, almost as high as 164, and since then it has absolutely gone into free fall. It's dropped below a line or below a level where it had managed to hold up in for the last couple of years, and in fact going back to 2010 or so. And what's more, it has also broken out of this large triangular formation, which has been in ever since 2009 or so. And a lot of people attach a great deal of technical significance to such a development. So why is this happening? First of all, and the reason for the pound's weakness is pretty simple. Really, it lies in the enfeebled state of the UK economy, which has been scraping along the bottom really for the past year or so. The economy, as we've now had confirmed, shrank in the last quarter of 2012, and even if we don't now get this third recession since 2008, there's no real clue that we're about to enjoy a full-blooded recovery, a return to the sort of normal growth that we saw in pre-credit crunch days. What's more, Britain has of course just lost its top-notch credit rating in the eyes of one of the agencies. That's not generally good for the health of the currency. And at the end of the day, however, the sort of weakness that we're seeing now could actually be in the country's interests. This is one angle of it, and for a weaker pound will obviously boost UK's competitiveness overseas, give us a much needed boost from trade. Although one caveat there is a lot of our trade is done with the eurozone, which itself has quite a few difficulties at the moment, and may not be a particularly receptive market in these conditions. But another thing that a weaker pound will do is it's going to create more inflation, which well, that's not good news for consumers necessarily. It does eat away at the value of government and private debt. So the bottom line is that the weaker pound, this decline we're seeing here, is actually probably more than a little bit deliberate on the part of the authorities. There's clear signs that the Bank of England and others are keen to talk the pound down by talking about open-ended QE and further money printing, that is. So, unsurprisingly, against this backdrop, we've got a lot of smart money in the form of hedge funds and others who are betting on further declines in the pound against the dollar and various other currencies. But how great a decline are we probably looking at here? One approach is derived from that triangular pattern that we saw earlier on. The usual interpretation of triangles is that the size of the height of the pattern can be projected downwards somewhere from the middle of the pattern, and then that would imply a fall maybe to as low as 130 or so. And there are some very bearish people out there talking about that. I've even seen forecasts of the pound is going to head much lower still. I don't want to get too carried away here. I don't think. I think that's good headline-grabbing material to make dramatic predictions. As a trader, it's safer just to go with the near-term trend, and I can see it in the not-too-distant future visiting maybe 140, and that's a pretty big drop from current levels, a 10-cent drop from current levels, which is a big fall in a market such as this. But currently, if we look at the daily chart, you can see that the latest decline has left the pound as very oversold on this indicator down here, which is the daily RSI. And when the daily RSI reaches very oversold levels, even if the downtrend is going to continue, you often get a kind of a snap back like you did here, yeah, or here, and then the selling can resume thereafter. So my strategy would be to allow this oversoldness that we see at the moment to correct itself a little bit. Wait for the pound to get up to this line here, this 21-day exponential moving average, and then, like it did here, and like it did here, and like it did here, I would then be shorting as the pound resumes its downward course. And it's fairly clear when this happened, because you get these nice long black daily candles. So that would be my preferred approach. Continue to go with the downtrend, but to short the end of failed rallies.